Ladies and gentlemen, markets are having a pretty damn good day today. Here in this video, I will explain why that is, what's happening, and what could be coming next. First and foremost, I guess it's important to say I'm not a financial advisor. This is not a recommendation. I could be wrong on this. I've been right on this in the last couple of days, suggesting that we could see a very strong start to 2025. That indeed has happened. So far, so good, but it does not guarantee that it will continue to be good. Now, I do think the right frameworks are in place for January to be a great month, and I think that's the most likely outcome at this point. But hey, it's financial markets. There's emotions here. Anything can happen. Now, Tom Lee and Fundstrat say something pretty interesting here on X today. They say the rule of the first 5 days, a metric that often signals how stocks will perform over the year ahead, is invoked this Wednesday. What key level are we watching? Now, it's actually interesting that they point this out. In 2018, you had a very strong 5-day period, but yet markets were still red. In 2015, you were barely, green during the first 5 days, and markets actually fell 1% over the next 12 months. It doesn't seem to me there's a whole lot of correlation between, this being good and the rest of the year being good, or this being negative and the rest of the year being negative. Like 2016, you were down 6% in the first 5 trading days, and then you ended up the year up 10%. Okay, now sometimes this does work. Like in 2019, you were up 2.7% in the first 5 trading days, and the markets were up 29% for the year. 2020, markets were up 0.7% in the first 5 days. Markets were up 16% for the full year. 2021, you were up 1.8%. To start the first 5 days. Markets were up 27% that year. 2022, markets were down 2% the first 5 days. You were down 19% that year, so that worked. 2023, markets were up 1.4% the first 5 days, up 24% on the year. And 2024, markets were barely red, down 0.1%, and stocks were up 23%. Now, you tend to have a win ratio during flat years of 50%, during good years or good first 5 days to start the year, you actually tend to be green 70% of the time. Now in 2025, the first day was negative 0.2%. The second day was positive 1.3%. And so far we're trailing for almost another 1% positive day. So as long as the next, 3 trading days are not terrible, or 2 trading days are terrible, we should have a pretty strong first 5-day return for the S&P. And that should be a good sign for the rest of 2025. Now, it is being reported the Federal Reserve Board has announced the resignation of Michael Barr as the Vice Chair for Supervision. Barr will remain on the Board of Governors. This is widely considered to be just a step down ahead of Trump becoming president, because he was likely to be fired anyways. And Fed Cook calls for caution on rate cuts, which I actually think is kind of positive at this point, considering the markets are not expecting much Fed easing at all next year. The fact that Fed Cook says, quote, the Fed can proceed more cautiously in cutting rates. She says the labor market has cooled in the past year, but remains solid. And she says, quote, over time, I still think it will likely be appropriate to move the policy rate towards a more neutral stance. However, the 100 basis points of rate cuts since September have notably reduced the restrictiveness of monetary policy. So she is still over here talking about rate cuts, which sounds good to investors. And it's also being reported today that Justin Trudeau announces that he is resigning as Canada's Prime Minister. US factory orders month over month declined 0.4% in final numbers. The forecast was negative 0.3%. The previous number was actually positive 0.2%. So a little bit of weaker economic data came out today. Now, also in the news today, Trump says, I will unban Biden's oil drilling ban immediately. Oil is not reacting too much. It's down about 0.1% today. And apparently Trump aides are prepping a major tariff rollout with one key change. On the campaign trail, Trump pushed universal import duties applied to every country and every imported good. Now Trump aides are still preparing universal tariffs in that they'll hit every country, but not on every import. Instead, these tariffs would only fall on critical imports, stuff critical for national defense, healthcare, energy production, etc. The idea is universal tariffs would prevent circumvention problems of shipping imports via third countries, but the narrow list limits price shocks inherent in hitting every import, at least in theory. So in theory, this could be tariffs without as much of the inflation risk. That's what markets are taking out of this. We don't know if that's the correct way to view this, but that's what the markets are taking out of this, and that is why you're having another good day. The Dow is up 0.63%, S&P up 1.05%, NASDAQ up 1.5%, and the Russell up almost 1%. U.S. durable goods data was revised to negative 1.2% from a forecasted negative 0.5%. The previous month was negative 1.1%. So we were actually expecting durable goods orders for the month of December to, get revised up from negative 1.1% to now only negative 0.5%. That was expected to be a big positive revision, right? Showing the economy is doing well. In fact, they were revised a little bit lower than we even thought. So that was like a 2 standard deviation miss on U.S. durable goods, which could be easing some of the, fears that the economy is going to be so hot this year, 2025, that the Fed's not going to be able to cut rates at all. And you can see 10-year Treasury yields have been pretty volatile overall at the beginning of trading today. 10-year Treasury yields were actually down on the day at 4.57%. Today, they're at 4.61% after hitting a high of 4.64%. It's really just tariffs, I think. Every time you get headlines on tariffs, 10-year Treasury yields spike regardless. You also had final data for S&P Global composite PMI at 55.4 versus the flash at 56.6. So that was weaker than expected for global composite PMIs. And global services PMIs final numbers came in at 56.8 versus the flash numbers, the first numbers that we got, at 58.5. So weaker than expected services and weaker than expected composite PMIs. And as I explained in previous videos, Foxconn had very positive things to say on their earnings yesterday. They said, quote, first quarter of 2025 should show significant growth compared to Q1 2024. And this is alleviating some of the fears that markets may have had heading into this upcoming earnings season. Now, if we look at the S&P from a technical perspective, I really like the price action today. We gapped up, okay, because of the news we have covered so far here in this video. But look at the level in which we gapped up to. It is your 20-day moving average. Now, you did get a lot of resistance around that 600 level on the SPY today. I will give the bears that. Definitely a lot of resistance there. It looks like the high of the day today was 599.70 for the SPY ETF, that is. And you've retraced lower at the time of recording this video at $597.25. Big retracement candle there. But it is good news that we held a lot of support around this 20-day moving average. Being above that 20-day moving average typically leads to a larger rally, okay? If you just look at this white line, this 20-day moving average, it's usually very important. Like once you break below that, you tend to fall a lot. You tend to gap down. Once you break above that, you tend to continue to rally. So now that we're back above that, we should continue to rally from here, especially if that holds support. The last time that happened was this series on November 15th, November 18th, November 19th, and November 20th that we were finding support at this 20-day moving average. You ended up bouncing from that 20-day moving average and rallied about 4.2% to a new all-time high from that level, of course. Okay, so that's one instance. I mean, there's others as well. Before that, you kind of gapped down and then you gapped up above the 20-day moving average. You ended up rallying about 3.7% there. Here, once you broke the 20-day moving average, you ended up rallying about 6% or so. Okay, so anytime you break that 20-day moving average to the upside, it tends to be pretty damn good. Right here, you broke the 20-day moving average to the upside after finding resistance, and you ended up rallying over the course of like 2 months, 8.25%. So the historical precedence of breaking that 20-day moving average tends to be very positive. Now, you're also seeing the RSP, which is the equal weight S&P, that is having a good day as well today, up 0.5%, but is finding a lot of resistance around this 100-day moving average. I would like to see a break above this and a kind of retest to the 63-day moving average, the 50-day moving average, and all of these other moving averages right here, which are around the 180 to 181 level. That's where I would want to see us kind of retest, because you're still down at the time of recording this video 5.5% from all-time highs on the RSP. So markets are still in a pretty weak place overall. You can see here my favorite indicator of market health is the percent of stocks trading above their 50-day moving average. It is at 41.1%. So 59% of stocks are still in an active, severe downtrend. They still have not broken into an uptrend, which is breaking above that 50-day moving average. I think that's the first step to being in an uptrend. So 59% of stocks are still in an active decline. There's a lot of room here to get back to like 60% of stocks that are, in an active incline, okay? Active, I wouldn't call it rally, but active uptrend, okay? So once this number goes from 41%, let's say to 60 or 65%, that's when some people's, fears or worries could be warranted again. That's when I would say maybe we are, back to a more neutral and or bullish place, and the rally could slow down here. I don't think we slow down with this rally until a majority of stocks are trading above their 50-day moving average. If you think about markets' expectations as well for 2025, it's not just big tech that is expected to have good earnings growth. It's small caps, it's cyclicals, it's industrials, it's basically every area of our markets are expected to have good year-over-year earnings growth in 2025. So you shouldn't just see one area really performing well versus another. You should see a broader market rally and what I have called a broadening out of this market. That is what we should see, and that is what I think we will see. Now, what's interesting, today, big tech is really, carrying our markets. I mean, look at Nvidia up 5%. A lot of that has to do with Foxconn. Foxconn's earnings that came out really solidifying the AI story. But it's really all your big tech names. Amazon's up over 1%, Microsoft up over 1%, Google's up 3%, Meta's up 3%. Netflix surprisingly looks to be in the red a little bit today. Apple's even up 0.68%. Big tech definitely carrying a lot of the markets higher here. I don't think this will continue throughout all of 2025. So I wouldn't be fooled by the big moves that you're seeing right now in these big tech names. I think this is an opportunity to actually deposition from these names, to kind of take some profits, get out of some of these names, or reduce some exposure, because I don't think 2025, the gains are going to be really concentrated in these big tech names like they were last year. Now, obviously, that's just my opinion, and of course, I could be wrong, but I don't like the big tech names nearly as much as the other areas of our markets. So let me know what you guys think about this down below in the comment section, but we are definitely off to a pretty good start for 2025. As long as the next 2 trading days are also good, that does bode well historically for full year market returns for 2025. And I do think people are just still so negative right now. There's a lot of room for things to get more positive. Even look at CNN's Fear and Greed Index. You're currently at 38. You're still in fear, okay? We were recently almost in extreme fear. So even after the last couple of days of the bounce or rally, whatever you want to call it, you're still very negative. People are still super negative on our markets. And I think there's a lot of room still to kind of even get back to neutral, or even more of a greed kind of area. I think with Trump coming into office here January 20th, there's room to even float into that greed category for markets. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a great rest of your day, and I will see you in the next one.